So let's talk about accounts receivable. Sometimes you'll also hear accounts receivable referred to as trade receivables, but essentially receivables represent monies that are owed to us typically by customers. So when a company makes a sale on credit and the customer is going to pay them at a later date, we call that accounts receivable. So as noted here, the most common transaction that creates a receivable is, of course, when we sell our merchandise or services on account. We'll debit the accounts receivable because it's an asset account that increases it, and of course we credit the sales revenue account. And then once we collect that receivable, we will credit the receivable and debit cash to increase cash. Credit terms are going to depend on the organization and what management sets up, but normally it's going to be something like 30 days to 60 days. 30 days is pretty typical. For example, if you see an invoice and it has the amount and it'll say due net 30, that means it's due in 30 days. So receivables are normally classified on the balance sheet as current assets because they are due in less than 1 year's time, which makes them a current asset. Now, notes receivable are a little bit different from accounts receivable. Again, accounts receivable are just those regular trade receivables that we kind of create on a regular basis as we engage in transactions with our customers. Notes receivables are more formal agreements. It could be with a customer, it could be with someone else, but it's a formal agreement. Think of it almost like we've issued a loan, to someone. We've loaned someone money. They are going to pay us back within some sort of given time frame, and there is generally interest involved with a note receivable. So a note receivable is a more formal agreement, and it is longer than an accounts receivable. Now, whether it is actually, classified as a current asset or a long-term asset, that would depend on the terms. If it's due in less than 1 year, then we'll still classify it as a current asset, but we'll categorize it separately from accounts receivable. It'll be listed separately as notes receivable. If it is due in more than 1 year, then it would be a long-term note receivable. So for most of our discussion here, we are going to focus on accounts receivable because that is by far the most common type of receivable account that companies are going to carry. Now, when companies make sales on credit, the expectation is that the customer is going to pay them at a later time. They're going to pay off that receivable. However, the reality is that a company is never going to collect all of their receivables. In a perfect world, they would, but the reality is there will always be some customers that just do not pay or do not pay the full amount. And so we often call those uncollectible receivables. Sometimes you'll hear it called bad debt, doubtful accounts. That's another term for it. So there's a lot of terms for it, but essentially it just refers to that portion of receivables that we will never collect. Okay, it's just we just kind of have to eat that loss, and it's a part of doing business and that sort of thing. So we've got two general methods for accounting for uncollectible receivables. We've got the direct write-off method and the allowance method. I don't spend much time talking about the direct write-off method for this reason. It is not permitted under US GAAP, okay? So if you are a very small business and you're not governed by US GAAP, you're not required to follow US GAAP, then you could certainly use the direct write-off method. But for any company that is required to use US GAAP, so certainly any large corporation, anybody publicly traded, they are absolutely required to use the allowance method, okay? And the allowance method simply says that we're not going to wait until debts become, uncollectible and then say, okay, well, we'll write it off now. We're going to go ahead and estimate our uncollectible accounts at the time we make the sale. The key advantage here is It allows us to match that bad debt expense directly against the revenue it helps to generate. And we're going to look at some ways for estimating those bad debts, because there is a little bit of method to the madness there. Okay, so essentially with the allowance method, what we're going to have, we know that we have accounts receivable as a debit on the balance sheet because it's an asset. Okay. The allowance for doubtful accounts is what we call a contra account. And it's basically like a little partner account to accounts receivable. It is on the balance sheet and it hangs out with accounts receivable. However, the allowance account carries a credit balance, okay? Which means that at any given time, we can take the accounts receivable account, net it with the allowance account, and that gives us our net carrying value for accounts receivable, which is essentially the net realizable value. It's what we think we'll actually be able to collect. And we're going to learn about the adjusting entry that's made, but under the allowance account, we essentially use the adjusting entry to get that allowance account where it needs to be at any given time to accurately represent the portion of receivables that we think we're going to be able to collect. Now, when we actually write off our debts, we're going to take that out of the allowance account, okay? And then the allowance account will essentially be trued up the next time we make an adjusting entry, okay? But we can still write off accounts using the allowance method, you know, when we know that the account is no longer going to be collected, but we want to also estimate those uncollectible accounts so that we can record the expense in the same period that we record the revenue. Now, we're going to look at two primary methods. We've got the percentage of sales method and the analysis of receivables method. Sometimes you'll also hear these referred to as the income statement method versus the balance sheet method. And it's all just, it's all really based on our focus, okay? So I'm not going to spend a whole lot of time on the percent of sales method because it's really easy and straightforward, okay? Under the percentage of sales method, management is just going to essentially, based on prior experience, estimate the portion of their sales that are uncollectible. So let's say that they look back at a 5-year history and they say, well, historically about 2% of sales are uncollectible. Based on that, every accounting period, they look at the sales for that period and they say 2% goes to bad debt expense and the allowance account because we believe that that's the approximate percentage of sales that we will not be able to collect, okay? Again, very, very simple. Now, once in a while, you might see someone use that just because it is a very, very simplistic method. However, the vast majority of big companies are going to use the analysis of receivables method, specifically the aging method, which we're going to look at an example of. But this provides a much more accurate estimate of our uncollectible accounts. Okay, so let's talk about the analysis of receivables method, okay? Using this methodology and this approach, we're operating under the assumption that the longer an accounts receivable is outstanding, meaning the longer that it goes unpaid, the lower the likelihood is that we will be able to collect it, okay? And really, this is just kind of a common sense thing, you know? If a customer's supposed to pay us in 30 days and it's been 120 days, the chances are probably pretty slim that we're going to be able to collect that. If they had the money to pay us, they probably would have already paid us, right? So we're far more likely to collect on a receivable that's, excuse me, that's 35 days out compared with, something that's 150 days out or that sort of thing. So the longer it goes uncollected, the less likely we are to ever see that money, okay? So if we're going to use this method, we have to look at the due dates of the receivables, and we have to look at where they are in terms of, is this invoice based on its due date? Has it came due yet, or is it past due? If it is past due, we're going to put it into different buckets based on the age, okay? And the examples that they use here is the 1 to 30 days past due, 31 to 60, 61 to 90. Some companies will also have a 90 to 120, and so on and so forth. It's up to management to kind of decide how they want to do those buckets, but 30 days is a pretty good rule of thumb for these little different aging buckets, okay? So we group every receivable into buckets based on the age of that receivable, all right? And then for each little bucket, we assign a percentage that we believe is uncollectible. And as you might imagine, the older it is, the bigger that percentage is. Okay, for example, if something's 1 to 30 days past due, maybe we say, well, there's a 3% likelihood that we won't collect it. But if it's 61 to 90 days past due, maybe it's a 8%, likelihood that we won't collect it. And I'm just making those numbers up. But as you can see, the percentage is going to get higher the older the invoice is, okay? And so we do that in each category, and then we add them all up, okay? We're going to see this on the next slide where we look at an actual example, all right? So in this case, and to keep it simple, it looks like they just looked at 3 specific customers, okay? But regardless of how many customers we have, we would use this exact same process. Now, as you might imagine, most accounting software makes it pretty easy to do this automatically, especially, for companies that may have thousands upon thousands of, customers and invoices outstanding at any given time. But again, the process is the same. So we're going to look at this simplified example just to get a better handle on the process here, okay? So it looks like the aging buckets that they've decided to use are not past due. So in other words, these people, Brock Company here, they haven't paid, but that's okay because their invoice isn't due yet. Okay, so maybe their invoice has only been out for about 15 days. It's due in 30. They've got a couple more weeks to pay before it becomes past due. Okay. And then we've got our groups for days past due. And again, it's up to management to come up with these. In this example, oh, sorry, I clicked on that. I didn't mean to do that. All right, so in this example here, they've used 30-day groups. We've got 1 to 30, 31 to 60, 61 to 90. Once it gets past 90, they've lengthened the groups a little bit, and they're lumping everything 91 to 180, 181 to 365, and over. These are for over a year old here. And again, these groups are up to each company. These are just the ones that they're using for this particular example. Okay. So we list, all right, where does this invoice fall? Okay, so we've got where it falls, and like in this case, it looks like this particular company, their balance of 6,100 is comprised of 2 different invoices or groups of invoices. So some are older than others. All right, but we go down here and we say, okay, based on prior experience. And again, these are not like hard and fast percentages. These, management's going to have to come up with this based on their experience with their company. But in this example, we're going to say, okay, for the ones that aren't they're not even due yet. We'll probably collect 98% of them, meaning 2% of them are probably going to be uncollectible. And once it goes into that 1 to 30 day range, we're going to say 5% is uncollectible. Gets to 31 to 60, 10%. Okay, and so on and so forth. And you can see, well, once we get way down here to an invoice that's over a year old, there is a very low likelihood that we'll collect it. Okay, So once it's over a year old, the company says, okay, there's an 80% chance that we will never collect that money, okay? And based on that, we are able to take our totals for each bucket, multiply it by the percentage, and this is going to enable us to compute what our uncollectible accounts balance should be. So in this case, now again, we can assume that there's some stuff that they're not showing here in the middle, and that's what's going to create all these totals that we see here. But what this tells us is we want the allowance account to have a credit balance of $26,490 because we believe that that is the amount of our current accounts receivable that are uncollectible. Now, in terms of what our adjusting entry is going to be, our adjusting journal entry is going to be for whatever amount is necessary to get the uncollectible accounts balance to this amount. So when we're using the aging method, our journal entry to bad debt expense is essentially a plug. It is a plug amount. It is whatever amount is required to get from our current balance in the uncollectibles account to whatever we think the balance should be, okay? So as a simple example, let's say that the current balance in the uncollectible allowance account, let's say that the current balance is $20,000, okay? Current balance is $20,000. We think that the balance should be $26,490. So our adjusting entry would be for $6,490. It's the amount needed to get from the current balance to the desired balance. Okay? So the key differences between the percentage of sales method and the aging method, again, the percentage of sales method uses the income statement approach. We calculate bad debt expense based on a percentage of current sales, and that calculation becomes the amount used for the journal entry, okay? Under the aging method, the balance sheet method, we calculate the desired ending balance for the allowance account. The journal entry to record bad debts is the amount necessary to achieve the desired balance in the allowance account. It is that plug amount to get from the current balance to our newly calculated desired balance in that account. Okay, so now we talked a little bit about notes receivable just a few moments ago. Let's look at some basic characteristics of notes receivable. The maker is the party making the promise to pay. The payee is the party to whom the note is payable. The face amount is the amount written on the face. Issuance date, of course, is the date that it's issued. Maturity date's when it's going to be paid. The term is the amount of time, and that becomes especially significant when we are determining how to classify that on the balance sheet in terms of whether it is current or long term. And of course, the interest rate is the amount of interest that must be paid. If there is no stated interest rate, then we must impute interest on the note because we have to assume that there is interest built into the note amount. Okay. In this chapter, we learn to calculate the accounts receivable turnover. This is essentially the number of times during the year that accounts receivable is actually converted to cash. We make this calculation by taking sales and dividing by the average accounts receivable. This will tell us how many times we turned over accounts receivable, and we can actually use this to make an even more significant calculation, which is days sales in receivable, sometimes called days sales outstanding. once we compute that AR turnover, we can take 365 days in a year divided by the AR turnover, and what that will tell us is, on average, how many days does it take for us to collect our receivables. And that can be very useful for management, especially if they are looking at possibly making changes to their credit terms and credit policies. So